You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hi guys, Coach Kelvin here. So today I just want to talk to you about my investment strategy and how I plan to retire in my mid-30s to early 40s working as a personal trainer. So obviously when you work as a personal trainer, you're expected to work a lot of antisocial hours, early mornings, late nights, times where everyone else is actually free. That's when you have to work. So whilst I love what I do, eventually it would be nice to have the choice of working on projects and working in work that I actually would love to do and want to do all the time. So that might mean that I work slightly reduced hours or less days per week, etc. My early retirement will still allow me to work on projects I'm passionate about, but it will not require me to work the standard sort of 7 days a week that most personal trainers do, or have obligations to work. It would be a work of choice that I use. So I currently am self-employed and I contract to a gym called the Coliseum Strength and Conditioning in Burswood, Perth, in Western Australia. And I also work for a transport business, and this gives me a fair amount of cash flow where I get a good amount from the transport business, and then I get to work in something I love doing the personal training. So how I like to invest my money and the investment vehicle I choose to use to get to early retirement is through the Australian share market, investing into broadly diversified index funds. Now, when I receive rental income from my investment property, at the end of every month, my funds land in my bank account, and I immediately transfer those funds over to Self-Wealth, which is the brokerage account that I choose to use for my investing. Now, Self-Wealth is brilliant, as it only charges a flat fee of $9.50 per trade, regardless of the size. It doesn't scale up according to size like some of the other platforms do, which charge higher fees already, such as CommSec, CMC Markets, etc. Now, when my funds land into my bank account, I basically aim most of my funds between 3 ETFs, and these are the ones that I tend to buy the most. So I alternate between Vanguard Australian Index Funds, which is VAS for the ticker symbol, VTS, which is the United States entire share market holding about 3,600 companies, and then also VEU, which is the entire world minus the United States, and again that holds about 3,600 companies. Now, based on whichever one is underperforming or whichever one I feel is underweighted in terms of my target for the portfolio, that's where that funds are diverted for that month. So for example, my average weighting is about 50% into the Australian share market. I have about 15% into VTS, the United States market, and then about 15% into VEU, giving me approximately an 80% allocation between those three. I then also have a smaller holding of around about 10% in both VAE, so this is the entire Asian share market minus the Japanese share portfolio, and then also I have VEQ, which is just all of Europe, for a bit more directed weighting and allocation towards that. Now, when one of these holdings is underweighted in terms of my target for the portfolio, that's where I divert my funds. And whilst I tend to focus on those main three, if I've accumulated any free trades from referrals using Self-Wealth, then I'm able to actually go down the path of splitting my $1,000 for that month between VEQ and VAE, and that just allows me to diversify a little more outside of those index funds into other companies. And for example, I'm glad I have done that because VAE has performed very well since the start of the 2020 pandemic. So when it comes to my asset allocation, I'm looking for broadly diversified, low cost, low management fees, and I'm looking for extremely safe investment opportunities that still give decent returns. So when I'm talking extremely safe, I don't mean bonds, because the return is very low right now, with bond yields at about 1.5%. Using these exchange traded funds, or ETFs, and through the Vanguard umbrella for that whole investment world, I'm actually able to produce returns that are much higher. And the average 100-year stock market return is generally around about 8%, and I'm actually earning more than that currently, which is very lucky. It's just due to the pandemic, we experienced a nice drop, and then I've had a very good recovery since then. Now, with the VAS or the Australian share market, I'm actually able to reinvest my dividends automatically. And this is a great opportunity because anytime during each quarter of the year that I receive my dividends, that just automatically purchases new ETFs on my behalf. So if I were to fall asleep and go into a coma and wake up 2 years later, I would actually have more shares than what I had when I first went into that coma, which actually excites me. I'm earning money while I sleep. And this is very important because, like Warren Buffett says, if you do not earn money while you sleep, then you will work until you die. And whilst that may not be true with retirement, etc., it's a good thing to think about because you want to understand, how can I put my money to work for me? So I basically figured out when I started investing into the Australian share market that if I were to add my $1,000 every single month until the day I retired, okay, so that would be a 40-year window from when I started, which is 25 to the retirement age in Australia of 65. Then my total allocated funds that I've put into the share market is $480,000 in Australian dollars. Now, obviously, I'm going to try and put more than that in on some months if I have a cash windfall, low expenses, etc. But my bare minimum that I'm willing to invest every single month is $1,000, and this is a non-negotiable. Now, the reason this is important to me is you may have bills come up like your car rego, house rates, etc. And if you choose to just drop the ball on that payment for 1 month, even if you miss 1 month, not only are you going to start developing the habit that, hey, it's actually okay if I miss this investing window because this came up, you're also going to potentially divert those funds somewhere else where it's less productive. So you don't want to end up just throwing away all of the hard work and the emotional planning you've done to try and stick to this strategy and just throw it out the window for no reason. So I'm very passionate about sticking to that plan, and in fact most months I actually put a little more in. So what I'm looking to do is, upon retirement, I'm looking for about 25 times my annual expenses invested in the share market. And this is following the Kitz's 4% rule. So this 4% rule assumes that if we were to reduce our portfolio by 4% every single year, whether that be in dividends or selling down some of our assets, our portfolio will still grow at a rate that allows us to never run out of money forever. Now, you can always be more conservative and aim to have even more invested than that. There's nothing wrong with that. But of course, if you get to the point where you have 25 times your annual expenses invested in the share market, and then you find some work that you're passionate about and decide to actually continue to work and earn some money, then you don't need to draw down as much on your portfolio. Therefore, you can leave it to grow a little more than if you were drawing down on that portfolio. Now, my annual expenses are currently around about the $25,000 mark, and this includes my interest that I pay on my investment properties, my living expenses for where I rent, car expenses, and then your general day-to-day living, so entertainment, food and groceries, and all those other things that come with just living a regular life, okay? Definitely coffee as well. Cannot go without it. So what you want to basically look at doing, okay, is how can I reduce my annual living expenses, because then that actually reduces how much I need to work in order to invest that much money. So for example, I just want to use a very round, simple number. If I can reduce my living expenses by even $1,000 per year, that means that is $25,000 less that I need to have invested at the point of retirement. So there are ways that I can reduce these expenses. For example, I could sell my car. If I didn't own a car, then I wouldn't have my $1,000 worth of rego per year, petrol expenses, maintenance, insurance. So let's say I would have cut out $1,300 just by doing that. That's going to save me over $25,000 just by not having to work, okay? So not by not having to work, but actually I would have $25,000 less invested, therefore I wouldn't have to work as long until the point I could actually retire. Now, why this is cool is because the more that you see that living expense comes down and the cost of your 25 years annual expenses comes down, the faster it is to actually accumulate and build up to that retirement goal, allowing you to kind of take the foot off the accelerator a little sooner. And perhaps when you get to the age of retirement, you could go into part-time work getting experience with a bit of a semi-retirement where you maybe work 2 to 3 days a week and you have the rest of the week off. So you're still earning a little bit, so your investment pace actually reduces, but as you're reaching the end of that retirement, the rate that your investments are growing is larger because you have more funds invested. Now, if you continue this down a long time frame and you gain momentum into this very sort of large trajectory, what's going to happen is eventually the amount that you contribute to your investments every single month is going to be less than what they grow by every single month. So let's just use, for example, let's say you had $100,000 invested in the share market, okay? And that's growing at an annualized return of approximately 8%. Without even working, you're going to have your investment portfolio go from $100,000 all the way up to $108,000. Now, why this is very cool is if you're sticking to the minimum strategy I have of $1,000 invested every single month, you're adding $12,000, but it's growing passively by $8,000, okay? So that's already 66% of the effort of that growth is actually coming from your investment gains. So when you're putting in $12,000 a year, but it's actually growing $8,000 by itself, that's actually 66% of that $1,000, okay? Now, if we look at over the next 3 years, that moves up to say $150,000 invested. All of a sudden, your $12,000 that you're adding is matched by the $12,000 that it's growing on average. Obviously, some years are going to be worse than others, some years are going to be better than others. But this is now giving you an annualized growth, including your additions to that investment. This is an annualized growth of about $24,000. Now, this is obviously much accelerated towards that retirement goal, and the further down you go, the faster you accumulate this wealth. Now, let's look even further. When you get to the point of, say, $500,000 invested, okay, at an annualized return of 8%, you're going to be making about $40,000 a year in investment growth. Now, if you only needed $20,000 to retire for your annualized expenses, then you've already got your 25 times annual earnings covered. That is done. That's done and dusted. However, let's say you want to be a bit more conservative and you want $40,000 to retire, you're already at that halfway point, because even though your investments may be returning 40 grand, that is not quite 25 times annual expenses invested. So we want to increase that just so we get to that point of safety. Your investments are always going to grow at a faster pace than what you're spending them, okay? So this is my investment strategy, and this is how I plan to retire in my mid-30s to early 40s. I'm currently 28, so you can join me on this journey and we can see just how far I can make it trying this strategy out, and I'll keep you guys updated. Don't forget to like, share and subscribe, and we can go on this journey together with personal finance.